All right. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. They even offer some of the highest yields in the industry, like the bond account's 6% or higher yield remains locked in even if the Fed cuts rates. What sets Public apart is how they give you the tools you need to make informed investment decisions. Their built in AI tool called Alpha doesn't just tell you if an asset is moving, it tells you why the asset is moving, so you can actually understand what's driving your portfolio's performance. Public is a FINRA registered, SIPC insured US based company with a customer support team that actually cares. Bottom line, your investments deserve a platform that takes them as seriously as you do. Fund your account in 5 minutes or less at public.com/investing unscripted and get up to $10,000 when you transfer your old portfolio. That's public.com/investing unscripted. Paid for by Public Investing. Full disclosures and podcast description. Hey friends, welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. Jason Hall, joined as almost always by my dear friend, the voice of the people, Jeff Santoro. Hey buddy.
Hey, how are you?
I feel good. I sound terrible, but I sound better than I did.
I didn't want to say anything, but yeah, you sound rough.
Yeah, it is the season for me where the thing that I use to make money is betraying me, but it's okay. I'm on some good medicine. I'm on steroids. It's the wrong. If you're going to take steroids, you want like the good steroids. I'm just on the like make your lungs better steroids. So here I am.
Yeah. I mean, if it makes you feel any better, we don't make any money on the podcast.
Touche. This episode brought to you by Unscripted Media LLC, where we make sure to lose money every year.
That's
All right.
right.
It's mailbag time.
It is mailbag time. So we have a bunch of questions from last month that we didn't get to. So we'll start with those. Then we'll get through as many of this month's as we can. As always, if you have questions for us, you can send them to us anytime via any method. We check all of the socials. We check all of our emails. So feel free to reach out at any point with a question. We keep them in a nice little folder for the next time we do a mailbag. So don't wait. Send them when you have them. And while I'm doing some housekeeping here, another friendly reminder for some 5-star ratings and some reviews on the podcast apps. It really helps people find the show. So with that said, Jason, are you ready for the mailbag?
I am ready. You were born ready. I am merely prepared. And I'm prepared because these questions are questions that we've had for a while. So I've had a chance to read them and think about them. And I'm going to cheat a little bit, and I'm going to immediately break the agreement for where we were going to start. And I'm going to grab a question from Sina that is, for me, it's really like, this is recency bias in my brain, but I think it's really useful. Sina says, from your chat with Jeff Fisher got me thinking more deeply about options as a supplementary approach, and asked a question. Jason, assuming you've used options for a while, have you gone through stages with them like a honeymoon, disillusionment, and refocus? So I want to talk about my options history going back maybe 10 or 12 years ago, where I tried using options and failed terribly. I tried strategies that were about catching easy, free money, and basically was buying calls and getting 100% losses on those calls consistently. Like they would expire out of the money and there was no value there. So definitely went through that phase of disillusionment. And it wasn't so much disillusionment with options, it was a disillusionment with my ability to use them properly. Over that decade since, two things have happened. One thing, I've become a much better investor, understanding businesses, industries, knowing where my strengths and weaknesses are as an investor. And I've also grown my pool of capital, my portfolio a lot larger. And what I've learned, Jeff, and this is something you and I've talked about, because your available capital for investing in options is smaller because of your, individual investing portfolio versus most of your assets behind a company 403B or your workplace 403B, I should say. So options actually gets easier when you have more capital to work with, because you have access to a lot of better, safer ways to use options for income.
Yeah. I mean, what I took from when we had Jeff Fisher on was he has a substantial dollar amount of cash because he has a large portfolio because he's been investing for decades. And rather than have that cash just sit, he's able to use it to write options, right? And I don't keep a lot of cash in my investing portfolio. We've talked about that. But I want to answer Sina's question from my perspective, because I've been actually following options strategies and trying very basic, simple ones with a lot of guidance for actually several years now. It's only recently that I've started to fly on my own, so to speak, and do them without guidance. And I've certainly learned some lessons. So the first one is because I was doing this with such a small amount of money, I was tying up capital for months, sometimes years, to get hundreds of dollars in profit, which is not bad. Like, I'll take any kind of profit I can get. But when you think about like the cost of locking that money
opportunity
up,
cost.
right? I don't know that it was the smartest thing, but it was a way for me to learn. I also had like a minor freak out recently with, and this is a complicated thing that's really only relevant to me, but I needed to close an option early and I couldn't. I wasn't allowed to. And I had to ask a lot of people and get a lot of help and try to figure out my way out of it. And I think that's the danger when you don't fully. Mine was a unique situation. It was out of my control. But I think in retrospect, if I knew a little more, I might have just taken care of it sooner if I was flying solo. So I think starting with strategies you really understand is smart. And, you know, the two rules I've tried to stay with are: don't do any sort of options trade with the stock that I wouldn't buy in my own portfolio. Like, I try not to just trade on names because the premiums are high. I try to only buy or sell puts or calls or whatever with a company that I'd be happy to have in my portfolio.
Yeah.
And also, if it's a covered call, I'd be happy to lose those shares.
Right. The inverse is also true. Exactly.
Right. So that has served me fairly well. Although I will say I have 100 shares of Celsius in my portfolio, Celsius Holdings, that I can't write options on right now unless I go really far out because it dropped like 25, 30% since I bought them.
The risk of being called away below your cost basis is substantial.
Right. So if I wrote an option now and then they could get called away at a big loss. So I'm just kind of holding on to them, and that would be fine. When I bought those shares, I was happy to own that company. It was a company I already had in my portfolio. I just bought a separate 100 shares to do the options contract with. But in the intervening time, in the months since I did that, I've lost conviction in the company.
Right.
And I don't know that I would sell it necessarily if I didn't want to take the big loss, but I don't have the conviction I did. So there's, you know, so those are just things you learn as you go along. I think the biggest lesson is, you know, don't do something that could blow you up.
I want to use 3 options examples of options contracts that I'm currently holding that are vastly different than the way I was treating options before. One is, this is a big win that I'm really pleased with right now. And I'm going to pat myself on the back so much that I might break my arm here. But in mid-January, I sold put $20 puts that expire next February on Confluent. So what that means is that somebody paid me almost $3 a share to have the ability to force me to buy this stock at $20 a share. I did this because I would be more than happy to buy Confluent shares at $20. But I did it with the expectation that it was very unlikely that the stock was probably going to continue to run higher as the business continued to prove out. The company reported earnings a day or so. We're recording this early to mid-February. Company reported earnings a couple of days ago. The stock has skyrocketed. And I'm in a position now where by the time you listen to this, I probably almost certainly will have already bought those puts back at about a 50% profit in a month. I was not expecting that, but I went into the situation, willing to buy the stock at a much lower price than it was trading for because of my confidence in the building, in the business. So even if the put itself turned out to be quote unquote a loss, because the stock was put to me because it fell below 20 and I had to buy it for 20, I was willing to take on that risk on the potential of making a good earning on the likelihood the stock would probably go up. I didn't expect it to happen this fast.
Right.
Now there's another one that is really interesting. Fluence Energy. I have also sold puts on this stock as well, about the same time frame. The difference is that Fluence Energy stock fell like 45% yesterday or the day before.
Saw that.
When it reported earnings.
Well, and just so everyone knows, we're recording this a little early, so this will be a couple weeks ago by the time you hear this.
Yes, yeah. So, but the point is that needless to say, the mechanics of profiting from that option are changed. Now, the thing is, it's a year out, the puts that I sold, and I sold it at a $10 strike price. The stock was, I think, over 15 when I sold it for that $10 strike price. So I built in a very substantial margin of safety. And then you factor in the premium that I was paid, and my break-even cost is around $8 a share. Now, but the stock is, what's that?
But that gets to the point of like the difference between, you know, doing option strategies or buying or selling options and versus like just buying a stock and holding it is like, you have to pay attention. Because let's say that 40% drop happened much closer to the expiration.
Well, not even just that. What if instead of using options, I just bought the stock?
No, I know. But I'm saying the point is you could, if a big drop like that happens and you're a little bit closer where it's harder to roll it and things like that, like you just have to pay more attention, I guess is what I'm getting at.
Exactly. But the key here is that using this put strategy, again, a business that I would be happy to buy at that price, I feel the margin of safety there, using the put strategy with an $8 cost basis versus having bought the stock at 14.5 the day that I sold those puts, I've potentially avoided significant losses in the short term while things play out with the business. And definitely better than the strategy I would have used 10 years ago to just buy calls that would almost certainly be expiring worthless at this point. Because I probably would have playing on a bump on earnings and figuring the stock's going to go up. And I just would have lost a few $100s. You do that every week, buying calls, weekly calls, and you can lose a lot of money really fast.
Yeah. I think the last thing let me say one more thing real quick.
Sure.
The question he asked was basically where we are with our stages of it. And he even asked me, what stages have I experienced and what stage do I think I'm in? I definitely was in a very excited phase when I first learned about options and I wanted to try them. And I was so excited about it. And it's only because I was following very directed guidance that I probably didn't make a stupid mistake. And now I'm much more chill about it, I guess. I know what I'm doing. There's one strategy I employ it very cautiously, but if it doesn't happen, I'm way more patient. It's not the end of the world. I was very excited as a new investor when I found them. And I think that's the danger. Yeah. Especially for people who don't think about investing all the time like you and I do. If you just come across options and you're just a complete noob and people are doing YouTube videos on how much money they're making, I could just see all the ways that could go bad. So I'm in the confident and cautious stage, I guess is what I would say.
Hey everybody, we'll be right back, but first a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes.
Investing Unscripted is brought to you by the Chit Chat Stocks podcast. That's right, another podcast you need to add to your listening rotation. My name is Brett, one of the hosts of the show, and I produce 2 episodes weekly along with my co-host, Ryan Henderson. On the Chit Chat Stocks podcast, we talk stocks from the hottest names to undiscovered gems, interviewing sector experts, studying super investors and why they are successful, and we have a fun time while doing it. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and never miss an episode. That's the Chit Chat Stocks podcast.
Got a question from Malu, I guess is how you pronounce it, M-A-L-U, who says, hope all is well with you. Could you explain the significance of return on equity and return on invested capital and how their relevance varies across different markets, industries, and company life cycles? Thanks for your insights. All right. So these are commonly abbreviated as ROE and ROIC. So if you see those acronyms out there, and if we ever use them, we're talking about return on equity and return on invested capital. So why don't you give a quick synopsis of those, Jason?
So I'm going to start with ROIC first, return on invested capital. When companies invest capital, so what is capital? Capital is funds that come from either equity, company raises equity, that's issuance of shares, there's common equity.
Yeah, let's just be clear. When people say equity, they mean people bought shares and now the company has money from the shares that they sold to those people.
Right. And that doesn't mean you going on your brokerage and buying stock. That's almost always a secondary market. The primary, when we're talking about company raising equity capital, they're doing a secondary offering or a private placement of stock or an IPO. That's how companies raise equity capital. The company sells stock and gets money back.
Right.
So that's one kind of capital. The other kind of capital is from debt. So you borrow money, right? Notes, convertible notes, that sort of thing. Those are ways companies can raise capital. So a company also could use cash off of its own balance sheet when it makes capital expenditures. And return on invested capital is just that. It's the rate of return that a company gets on capital investments that it makes. It's the return on that capital. So that's very different than return on equity because again, it's invested, all of the capital that's invested that's the return on that. Return on equity generally should be better than your return on invested capital because you're getting a return on all of your capital and it should compound because of leverage. Leverage should allow you to get better returns. The most pure example of when return on equity should be higher than return on invested capital or like return on assets is a bank because they're very leveraged, right? The vast majority of the capital they have comes from deposits and borrowings, the bank's borrowings, and maybe 10% of it is from equity, right? So that's why like the common, and again, I'm not talking ROIC here, I'm talking return on assets with ROA, but the return on equity, like a bank should earn 10% or better. Most banks should earn 10% or better. The return on their total assets, because it's very leveraged, 1% or better is generally considered like the gold standard for what is a really high quality bank. So depending on how much leverage the business uses is going to affect what those returns are going to look like. It can be very different from industry to one industry to the next. And there are things too that might seem counterintuitive. You might have a business that has relatively low net margins that can get better returns on equity and returns on invested capital than higher margin businesses might. For example, you might have a distributor that gets really high returns, even though their margins are lower because they're really good at turning their inventory a lot, right? So maybe they sell twice as much. They turn their inventory over 2 to 3 times as much as a company in a different business that maybe gets a little bit higher margins. It doesn't get as good of a return. So they leverage their assets that they have better, their real estate better, all of their operations dollars, even at lower margins, because it's turning over more dollars at those lower margins, you get better returns. So, and thinking about those metrics in terms of, again, markets and industries, you're going to see different levels of return that are going to be considered acceptable. But in general, you want to see double-digit returns over the long term, because that's the thing that's going to drive per share value higher and drive earnings per share and free cash flow per share higher, is getting those double-digit returns. Now, life cycle too, what you should see with companies is those return metrics should be good relatively early. When they're spending and they deploy an asset and they put it into operation, the return on that should show very quickly if it's a high quality business. The goal is for companies, as they mature and maybe their growth rates stabilize, they should start getting better operating leverage and those returns actually increase from there. One of the things that you're going to see too is the difference in companies that maybe are making acquisitions. They might be a little more lumpy as they integrate acquisitions, drive out costs, get all the synergies and things aligned. And then the result is better incremental returns over the long term. So sometimes you see that with acquisitive companies that do lots of little small bolt-on acquisitions as they're taking market share, consolidating the industry there and that kind of thing. But the long tail should be consistently growing those ROE and ROIC metrics. And if they're not, go to the S1 and look at management's, or not the S1, but look at the proxy statement, look at management's compensation. And if they're just being compensated on stuff like earnings growth or revenue growth, they're getting bonus to empire build and not create per share value.
Yeah. I track ROIC on my spreadsheet for all the stocks that I own. And it's mostly because I'm mostly doing it to watch trends. I want to see if it's heading up, if it's heading down. And then if it's heading down, I want to find out why. But I don't use it much to compare businesses to other businesses unless they're in the like a similar industry. It's, for me, it's more of a signal to look a little closer to see like why it might be trending in one direction or another. Okay, got a question here from John. On a recent video, you talked about stocks you purchased for your children's portfolios. My children graduated long ago, and now I'm investing for 2 young grandsons. They are too young to have any interest or input, but that will change over time. I'm fortunate that I don't have to start from nothing and build a portfolio over the next 20 years. Instead, 3 years ago, I set up a Roth account in my name, but dedicated it to them. I invest a fixed dollar amount into each of 20 stocks chosen with the intention to hold for 20 years. I'll make annual additions primarily to the same stocks. I think this will provide many investing lessons as we go. I chose a mixture of growth and value stocks with about half paying modest dividends. And then he goes on to list the stocks and ask what we think about them. We're not going to go there. But the question is, what do you think about the overall concept for a grandparent to stay involved? What do you think?
I think it's really interesting using a Roth as the vehicle for doing this. I want to talk about the mechanics of this first of all. One of the cool things, Jeff, about a Roth is you don't have to just use it as like a tax avoidance income optionality strategy in retirement. If you're fortunate enough to have created enough overall wealth, you can make it a really interesting part of your estate planning. Because with a Roth, whoever you will that Roth to, all of the tax-free implications that existed for you exist for the person that you will it to. So it's a way to pass tax-free wealth along to grandkids. So I think that's a really interesting, thought-provoking way to do that. So that's really cool. I like the strategy.
The other good thing about doing it in your own name and then just planning to gift it to them later is
doesn't screw the kids out of being able to get financial aid for college.
That's one reason. Yep.
Yeah.
But the other one is, they might grow up to be kids who hopefully they're going to be fine, but they're not ready for that kind of money yet. You know, like if you're adding that much money to it, by the time the kid's 18 or 21 or whatever the age of maturity is in your state, if that's in their name, they're going to get that money, whether they're responsible with it or not. And so it kind of gives you the control to be like, all right, maybe when you're a couple years older, So to me, I think about like the portfolios I have for my kids. I don't contribute much to them. I just sort of got them started, and they're very modest. They are in their names, and I'm keeping them modest for that reason that you just mentioned. Like, this is not the kind of money that's going to determine financial aid, yes or no, or anything like that. It is like literally hundreds of dollars. So, but I wanted them to just have a starting point, and I wanted to be able to say to them whenever they do finally get an interest in it, hey, look, this started out when you were 7 with $50 in Apple, and now it's whatever, $200, whatever it is, whenever that conversation is happening, just to kind of show them like, this is what happens when you buy good companies and hold them for decades or many years. And then I'll turn it over to them at some point, and just, they can do with it what they please. They can add to the companies that are in there. They can sell them, buy new ones. I'll help them if they want it. But for me, it was just a way to get them started. They're 16 and 12, and so far neither of them has any interest in any of this stuff other than the concept of like saving for the future. That they understand, but no interest in like picking stocks or anything like that. So I think it's an interesting strategy.
One of the things John's doing that I like here too is the idea of committing to 20-year holding periods, because I think there's the value here with these kids at some point when they're not kids that are uninterested and they get to the point where they can start understanding the idea of what we're talking about here. You can show them not just, hey, here's this money, but you can show them the successes. And along with it, you can show them the ones that went spectacularly bad that never came back. And despite that, here's some money, right? So there's definitely some potential value there. Of course, the really interesting thing to me is going to be when John shares his experience with us in a decade, when we're still, of course, doing this podcast from our private island.
Yeah.
And we'll fly John out to come visit us with the grandchild that's following in his footsteps, and an investor. And then we can Zoom with the grandchild that's in jail and talk about where they went. I'm kidding. But no, seriously, like the story of how this plays out and how the kids respond to it is one that I would love to be hearing about in the future.
Yeah, absolutely. I agree. All right. Next question is from Caleb, who writes, would love to hear Jason's thoughts on Upstart. Sentiment rose on back-to-back improvements, and then the Fed's placeholder predictions for the year caused a reversal, but Jerome consistently insists that he can't even predict the next month. Defaults have been the real problem anyway, not interest rates. All right, Mr. Upstart, what say you?
Well, since we got this question, Upstart
there's been some news.
Holy cow.
Just today, it's up 30%, right?
Yeah, so Upstart reported, so on the 11th, after the market, stock up massive amount. And here's the bottom line. This is one where not only were the results really, really, really good, I think revenue was up like 56% across the board. All of the metrics that matter got better. Operating loss shrank substantially. Like all the automation things are getting better. Growth of all the relationships with partners like banks. I think last year they added another 28 banks and credit unions. Existing relationships with investors, those existing investors committed another $1.3 billion pre-commitment to buy originations from Upstart. That's big. They're saying revenue this year is going to be about $1 billion, which is like, I don't know, 50% higher than it was last year. Maybe not that. I think it was about $600 million this year. So they're big growth, though, is the point. And what it says is, hey, all the things that we've been saying about our platform to identify more accurately who is truly creditworthy and who's not, it's working. And private lending and banks are saying, you're right, we're going to be using your platform more. It's right there in the numbers, not just how great the fourth quarter was, so much better than expected, but the management is saying, hey, we're going to have another great first quarter, and then our growth is going to accelerate from there. So the growth rates that we saw in the fourth quarter are going to accelerate. That's incredible. They're going to be break even on a GAAP basis is what they're saying. And based on their guidances, I would not be surprised if they don't exceed those results, but it's all dependent on what happens with the economy, right?
I was just going to say,
that's the thing.
Yeah.
That's
I mean,
the thing.
the thing that I know of Upstart, I mean, I own it. I don't follow it nearly as closely as you do. It's still a little bit in my too hard bucket to follow all of the ins and outs. But what I do remember over the last several years, as the stock has at times struggled and the news has not been as good as this quarter's news, the one thing I remember is they consistently seem to be adding partners, banks and other institutions that they were signing deals with. And I always took that as that's a good sign. And they just need to kind of get past this rough patch. What worries me a little bit about the pop that we saw today on the 12th is, like you just said, like that's a lot of time in the future to be predicting in a world where like a lot can change in between now and Q2. So yeah, what happens in the economy? Is there some sort of market crash or consumers get shaken, like interest rates go back up again? Like all these things are possibilities between now and the end of Q2, which is going to give that's the one that reports in like August. So there's a lot that can happen between now and then. And I just worry that like with that big of a pop, how much air comes out of that balloon if those quarters disappoint compared to what they say they're going to be. So that's something I think is worth keeping an eye on.
Yeah, I think in the near term, absolutely. But I will say this, the market cap right now is about $8 billion after today's huge jump. Two things I can absolutely predict are going to happen. The stock's going to be crazy volatile from here because there's still so much speculation and expectation, both on both extreme ends for what's going to happen with the business. But I do think 5 years from now, this price is still going to look like a good price because there's clear evidence and their ability to rate credit worthiness is there. It's really good. And they're still just barely tiptoeing, putting the tips of their toes in auto and real estate, which are much bigger markets and safer markets for lenders too. They're just barely putting their toes into those markets. So no, I still think the long-term story is really good.
Hey, everybody, we'll be right back. But first, a word from our sponsors.
All right. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. You can even earn some of the highest yields in the industry, like the 6% or higher yield you can lock in with a bond account. Public is a FINRA registered SIPC insured platform that takes your investments as seriously as you do. Fund your account in 5 minutes or less at public.com/investing unscripted. Get up to $10,000 when you transfer your old portfolio. That's public.com/investing unscripted. Paid for by Public Investing. Full disclosures and podcast description.
All right. Next question from Simon. Hey guys, what are your current thoughts on Confluent coming up the next earnings report?
Here's another one that reported already. So great quarter. Confluent is one that I've continued to be really high on the business, even when a lot of other people have lost a little bit of confidence. Growth rates have slowed a little bit. We go back about a year and a half ago. There was a little bit of churn with some customer concentration. One of their larger customers was acquired. And so it kind of reshuffled things a little bit and the growth rate slowed. And they said, look, things are going to accelerate again. Growth rates, they did accelerate, right? So I want to say that even though not the rates investors were wanting to see, and management's been steadfast that look, our product is winning in the marketplace. We're growing large customers. Our large customers are growing their spend with us. And we're starting to see that economic flywheel really work out where it's kicking out more and more cash flow, the gross margin story is good, but the operating results are getting better as it's getting to scale and operating leverage is kicking up. And they continue to build a product to help customers deal with data in real time, wherever their data lives, whether it's in the cloud, whether they have servers in the office, like their own, they're not using the cloud, or some hybrid mix of both, which is most companies, especially at the enterprise scale. They have the tools to meet those customers' needs, and it's open source. So there's a lot of freedom for businesses with the open source model, and they keep making little acquisitions that are smart to strengthen and to add features and capability as data streaming continues to evolve and mature. I think data streaming is going to continue to become much, much bigger, and there are going to be other winners too. Some of the cloud providers have their own proprietary products as well, but I really think that Confluent continues to be underappreciated. And as much as the stock went up, in this recent little run, again, I still think it's a small business that can get much, much larger. And I think even after this run up, it's really attractive at this price. Again, this price as of the end of the day on February 12th. When this comes out, I don't know what it's going to be at.
Yeah, a lot can happen in a couple of weeks. All right. From Colin, I have a bond ETF question. I want to invest in some bonds I plan to sell in 2 or 3 years to pay off the rest of my mortgage. There are short-term bond ETFs that are less than a year to maturity. Does the bond re-rate after the year? Why wouldn't someone take the higher yield and just hold it for the long term versus a longer-term bond with a lower yield? I know I'm missing something. In summary, ultra short-term bonds have higher yields, are normally for 1 year or less. What happens when you hold it longer? Same for bond ETFs that are 5 to 7 years. What happens when you sell them after 2 to 3 years?
So with bond funds, you don't own the bonds. You own a share of the fund that owns the bonds. And they're regularly turning over their inventory of bonds based on liquidity needs, asset, capital inflows from investors investing in the ETF. But what you have is the directionality of that particular category of bonds. And Jeff, we're still in this inverted environment where short-term rates are higher than the longer-term rates because bond traders and debt investors are expecting rates to go down over the long term, right? They're not expecting them to come down a lot, but there's still that expectation that rates will fall from where they are now. So the idea is you want to manage your exposure based on your capital needs is generally the way to think about it. So for money that you're not going to need for 5 or 10 years, but you don't want to have it invested in stocks or some other highly volatile class, the idea is by buying those longer dated instruments, eventually what's going to happen is the market's going to reset, right? And the yield that you're getting is going to adjust up and down based on the yield being paid by the bonds that are owned by the fund. But the market value will constantly be in flux based on what interest rates do. If interest rates go down, the bonds that are held by the ETF become more valuable, right? That'll push the value of the ETF up.
This is what screwed bondholders in when the interest rate cycle started, right?
It was the other way. It was the opposite, right?
The rates
Where
going
interest
up
rates
made them less valuable.
skyrocketed and it gutted bond prices. For ETFs, for anybody that if you own the bond to maturity, you don't take the bath because you get all your money back when the bond matures.
Right, but you don't own the bond when you have the ETF.
Exactly. So that was what made that period so brutal. So I don't think the risk that we saw is there anymore. That risk has basically been washed out because it's hard to imagine a scenario from these interest rates where interest rates are going to start shooting up again, right? So the key again is there's no re-rating because there's not like the day that you buy, they mark your account and it's only attached to certain bonds and then they re-rate it in 2 years. You just own the bond ETF. You're a shareholder in the ETF, the fund, and your value is based on the assets, the market value of the assets that are owned by that ETF. So hopefully that kind of answers the question.
Next question here is from Cunning Project. What are your thoughts on CEFs, which stands for closed-end funds? They usually have monster dividends. And what's a little leverage to keep you honest?
Yeah, the problem with closed-end funds is they don't use a little leverage. They use a lot of leverage. So a closed-end fund, in short, is basically it's like your own private equity that's a stock. And they raise capital almost always just one time. They bring it public, raise capital with a stock, they raise equity capital basically that one time. And then they use it to buy stuff like a private equity business would. They go out and buy businesses, sell them. And like REITs, imagine like a REIT that can't do a secondary offering to raise more capital. What are you going to do? You're going to take on a bunch of debt. So that's the private equity playbook, right? Is to take on debt to leverage and juice returns. And used appropriately, it can be a useful way to get outsized returns. The problem is closed-end funds, they do tend to pay out all their excess capital. They don't retain a bunch of it. And you end up with these over-leveraged things that don't always generate great returns. As a category of assets, they're not great. They have not done good for investors. And for that reason, I tend to avoid them because we don't get bonus points for finding the one good one in the bad industry. So I don't think that closed-end funds are really, for most people, are smart investments when you can get predictable, better returns and dividends that don't get slashed when they get out over their skis and now they have a mountain of debt they have to service in other ways.
All right. Next question comes from Gorsk. And I love this one. It's very meta, very, not the stock, but it's very deep. So Gorsk says, here's the question for you on frameworks. I love frameworks over rules, but it strikes me that saying you should have frameworks but not rules is in itself somewhat of a rule. And then he says, I have a rule to never do what Jim Cramer says. Is that acceptable?
That's so good.
It is good.
That's so
I'll
so
start
good.
by saying I agree that you should have a rule to never do what Jim Cramer says, but that's because I think you should have a rule to never do what anyone says, because that is not the way to invest. But yeah, Jim Cramer's track record is not something that I find terribly enticing, but he brings up a good point. If we say that you should have frameworks, we're framing it like it's a rule.
I want to push back just a little bit because my mantra is frameworks over rules, not frameworks instead of rules, and certainly not frameworks, not rules. The point is the world changes, and sometimes the rules that you in your life changes and your financial needs change and where you are in your life changes around your investing goals. And a lot of times we put things like rules in, and we're humans, and humans do things the way we do them because it's the way we've always done them. And we forget about that sometimes. So I think that's the danger with a system that's too rules based, right? And again, what we say about frameworks, Jeff, rules tell you what to do. Frameworks tell you how to think, help you think, help you make better decisions, and building things into a process that help you think them through to reach better decisions that are going to inform better outcomes based on your financial goals is just a better way to do it. But yeah, don't ever do anything but don't ever do anything what's his name? Yeah, don't do what Cramer does. I'm kidding.
I'm not kidding. I don't do what he says. I'll say it. All right. Next question comes from Jamie. Jamie said this. He thought this would be an interesting topic for one of your shows, and I don't disagree, but I think we should answer it here as a question as well. So Jamie says, there are a couple of companies on my super strong conviction list that I opened a starter position in and was looking to add to if the price of those stocks continued to, or at any point traded at what I deemed as a compelling value. The problem is they have been going up parabolically ever since that starter position, leaving me constantly in fear of buying shares at more elevated prices. And due to this fear, I have missed out and had a huge bull run on these particular stocks. Those stocks are Axon and AppLovin. What am I doing wrong? What is the proper way to think about these companies when evaluating these kinds of stocks, even when the price is shooting up aggressively? What do you think? I forgot. There's one more part of this I should read.
Okay.
The reason he's so cautious about chasing stocks on the way up is he got burned on companies like Zoom Communications and chased it all the way up only to see it crash down. So that's a little bit of context. I didn't scroll down far enough on my screen.
So first of all, Jamie, I think there's a lot of price anchoring happening here and a lot of FOMO happening here. Also, I think there is a very good probability what you're doing wrong is that you're doing it right. Maybe you learned a little bit from those lessons, because I think we often make the mistake. And again, Jamie, I'm not telling you individually what to do, but I'm using your situation as a hypothetical thought experiment of having gone through that experience. It's human nature when you buy a stock and you see it just rocketing higher to both want to buy more and also be terrified to buy more because you've touched that hot stove before, right? And the implications of what happens on the other side when the run stops. So I want to talk briefly about the price anchoring part first, because I think as a starting point, the biggest mistake every single investor makes at some point in their life is buying a stock, seeing it go up, and then thinking immediately it's a mistake that they didn't buy more and that it'd be a mistake to buy more now. If you're going to continue to hold it because you think it's going to continue to go higher, obviously you believe there's some reason the stock can continue to go higher, right? So therefore, is it really a mistake to buy more of that stock? Moving on from price anchoring to think about valuation is the number one step. What's changed between the day that you bought the stock and the price of the stock today, fundamentally with the business, that's made the stock price go up? And does the multiple now, what is free cash flow per share? What is price to sales for like Apple? Whatever metric you're using to try to determine fair value for the stock. Is the stock really expensive? And I'll say in the case of Axon, yeah, that stock's gone crazy expensive on most multiples. So the point is that if you objectively try to pull the stock price out of it and look at the results of the business, and also what is management saying the business is going to do next year and the year after that and 5 years out? Because I promise you that analysts are looking at what management is saying, and then they're making their own estimates on future results. And that's playing a big role in the price of the stock today, because that's what it's being based on, not what the business did last year, but what's the business going to do next year and the year before. So reset your paradigm around the price of the stock today and ignore what you paid for it before and think about what is it worth? What, based on how long I want to hold it and the results of the business now, And is today a situation where there are unreasonable expectations baked into the price? But I love the business and I want to continue to hold because I think it'll continue to create value. But from the lesson of the Zooms, I don't want to make the mistake of the inflated expectations price and throw good money after bad right now. And doing nothing is the right decision, and looking for other opportunities. Because some of my best investments and my biggest winners aren't when I bought it and then I bought it again in 6 months in the big run, or a year later in the big run, but multiple years later, right? I've talked about one of my biggest winners, Mercado Libre, a stock that I bought multiple times over basically 15 years now almost. So being patient, and remember, when your investing timeline in stocks is measured in decades, you don't have to build out a position in 6 months or 2 years. You can take multiple years to build out a position, and look for other opportunities in other places, or just you don't have to do anything sometimes, right? Let the businesses do all the hard work, and sure, you may build up some cash, but don't get so fixated on having to put more money in those winners when the stock's doing all the winning right now and the business is doing fine. You got to find some equilibrium there.
What this makes me think of is knowing thyself as an investor and the kind of person you are and what you can tolerate. Because there's two ways to think about this in my mind. One is what I do, which is if I buy a starter position, it is a smaller than a inconsequential amount of money in my portfolio. Like it is a tiny, tiny amount of money, because it's for me just a chance for it to be on my radar so I keep track of it. There are other people, David Gardner from the Motley Fool, who are proponents of decide what you want this investment to be sized as and buy it in thirds no matter what the price does. Like that's how he would invest, as I've heard him say that on multiple podcasts, right? So like, let's just say, I'm just going to pick a random dollar amount. Let's say you want to put $5,000 or $10,000, whatever. And you decide I'm going to do, 3,300 today, 3,300 in a month, 3,300 in 2 months, done, right? Or this quarter, next quarter, the quarter after that, whatever the time frame is. But then you have to commit to doing it no matter what happens. But that's like a discipline. Like this is how I invest. That's one way of doing it. Another way is just be really, really patient, because yes, you will see some stocks go parabolic, but chasing them can turn out to be like Zoom, or it could turn out to be a really great decision. And I think that comes down to what your risk tolerance is, what your timeline is, how much you can handle the volatility. Because that happened to me. Like I talk all the time about my dumb luck of buying NVIDIA a couple of years ago. I haven't added to that position in two years, and I've watched it quadruple. So it was a tiny amount of money. So of course I think the same thing, but I also believe that over time, it's going to come down to evaluation. It already has come down to evaluation that is not far away from where I bought it.
Yeah.
Despite the stock being up 500 and something percent price wise, it's trading for price to earnings, price to free cash flow, price to operating cash, not that far off from, and some of those metrics lower than where I bought it several years ago. So that's, you said it at the top. Think about the valuation, not so much the price, because sometimes they can be two different things.
I want to just one more thing I want to hit on this for AppLovin. This is a stock that's gone very near parabolic. It's up over the past year, like 720%. Over the past 5 years, it's up less than 500% from the peak in late 2021 through the sell-off, the bear market in 2022. The stock was down a pretty good bit, but it's up about 480% since then. Over that same period, free cash flow is up 700%. Sometimes the market catches on a little bit later. I'm not saying objectively on a multiple basis, AppLovin's price makes any sense today. I'm not saying that it does. But what I'm saying is when you zoom out and look at the share price change and the amount of free cash flow growth of that business over a 5-year period, even with the big run in the stock price, free cash flow has grown at a much faster rate. So zoom out, I think, is always the best starting point with these businesses, and try to find some way to be a little more objective about it. All right, what's next?
We got one more question here, and then we have the spam comment of the month. Last question comes from Victoria, who says, hello, first of all, I've been listening to the podcast for over a year now, and I'm so grateful for all of the education you provide. Well, thank you, Victoria. That's very kind. I was wondering if you could do an episode on investing in ETFs versus individual stocks. I hear so much about how ETFs are the best for passive investors, but then I hear people talk about how too many people are investing in them and the negative aspects, and I would love to hear your thoughts and insights. So Victoria, we will absolutely keep this in our idea for a show category of emails, but we can answer it here too, I think. So Jason, what are the downsides of investing in ETFs? When she hears people talk about how too many people are investing in them and that there's negative aspects, what is she hearing?
I think the starting point is the negatives is that you're buying everything, right? Which ironically is actually one of the positive things too. For most people, most people are just not going to know, right? What's a good stock and what's a bad stock, right? Even, Jeff, you and I, when we first started as investors, was honestly probably a year or two into our time before we knew the difference between a good stock and a bad stock. Actually started to learn just that basic idea. So when you're buying an ETF, you're buying everything in that index, including the junk, the things that you would never pick on your own, right? The things that are going to weigh on your returns. When you own the ETF, you don't have the ability to really participate as a voter in the companies that you own through your interest in the ETF. You don't have the ability to weigh in as a shareholder on those businesses. So that's, some negative. There are fees, right? The fees are becoming so much smaller in terms of weighing on your returns.
But not all are created equal. Some ETFs have much higher fees than others.
Right. So there are fee traps you can fall into, especially you get into the more like specialized ETFs where you're like looking at just a certain industry or sector or a theme or a trend or, that sort of thing, or like an investing style or strategy. The fees can get pretty big. There's all kinds of like financial bombs out there too. The leveraged inverse ETFs that people have no idea what the hell they're buying or that can create risk as well. So there are definitely plenty of pitfalls. There's an idea in the financial world that ETFs are becoming so big that they're illegal in certain ways, between the Fidelities and the Vanguards and the iShares that essentially control companies because they're the ones that own the shares, through us as investors. So there's the idea that it's too concentrated. The control of these businesses is too concentrated to the point where this means that these big investment funds, they control the industries, right? Because they own most of the Coca-Cola and most of the Pepsi and their competitors and all of the automakers, right? So they want all of these companies to make money and their stock prices to go up. And that means that the companies, because they all run up to the same owners, it's basically anti-competitive, right? Where the companies can't really compete with one another because of the conflict of interest of the share owner, which would be the investment funds, right? So I don't fully buy into that. But the other thing too is that because of what we've seen, here's maybe a bigger risk to a headwind for returns over the next decade is the extreme concentration in 10 or 15 companies that make up more than half the S&P 500, right? So because a market cap based instrument. So you have 500 businesses that really only, 30 or 40 of those companies are likely to be meaningful on your returns. And 10 of those are extremely expensive, very, very large companies. So you have far more individual company risk for those businesses if those businesses don't perform well as investments over the next decade that could meaningfully affect your total returns versus buying individual stocks without having the same exposure just to those large businesses. So I think that's a risk a lot of people don't realize they have.
The only thing I'd add to that is not all ETFs are created equal. I think investing in one of the ones that just tracks the S&P 500 is a very different animal than, like you said, finding the specialty boutique ETFs that only invest in oil and gas companies that start with the letter A. And the second thing I'd say is one fun way to use ETFs is to, search for the things you're interested in and then just see what the holdings are. Because sometimes by looking at the holdings of the ETF, you can actually give yourself some stocks to look at if you're interested in being a stock picker as well. All right. We're at the end of our time here, Jason. So it is time for the spam comment of the month. This one comes to you, as all of them do, from the platform formerly known as Twitter. And this question says, "Hi, I think your smile is very warm. Can we get to know each other?"
My response to these is always, I am a podcast. Podcasts don't smile.
Yeah, they are. I have to say, going through the tons of spam we have in the show account, there's a lot of similar questions to that. Another one here, "Hi, you seem very friendly. Can we be friends?" There's so many people just reaching out to be friends with us. It's
kindness
nice.
of our hearts.
Yeah.
The cynical me might think that this is like catfishing for lonely bros, but
No, it's definitely people who want to be our friends.
of course, we think the best of the world, especially the world that is Twitter. All right, friends, we love answering your questions. The mailbag is one of our favorite things that we get to do. But just like every other episode we do, we answer these questions with our answers for us and for you to borrow. Try them on, see what you think about them. But at the end of the day, you've got to make your own decisions and find your own answers to the hard questions about investing, personal finance, and more. But as always, I believe in you. You can do it. All right, Jeff, we'll see you next time.
See you next time.